When it comes to investing in the future and generating huge returns in the process, most people these days look at the big fang stocks. But what if I was to tell you that the old school tech giant IBM might be actually able to do the same thing for you while trading at a far lower multiple? But can this old school titan, which in the most recent years underperformed quite a bit, actually surpass shareholders' expectations and is now the time to buy IBM? This is Might As Well Invest, becoming smart money. Before we however get into one of the few analysis videos on YouTube that doesn't include the stock 100xing in the next week, I would still like to ask you guys to destroy that like button so we are able to reach more people with these kind of videos. IBM, which was founded in 1911, is up to this day one of the leading technology companies out there on the stock market. However, it has to be said that their market cap of 132 billion only represents the status to a certain extent when compared to other tech giants out there. However, this is still extremely sizable and can to a decent extent be attributed to the company's revenue of about 73.6 billion. In order to get an idea of what may drive IBM going forward, let's however break that revenue down a little further. Generally speaking, IBM divides their revenue into quite a few segments, which I however summed up into 4 segments. The biggest one of these being the global technology services, with about 25.8 billion in revenue. These are then followed by the cloud and cognitive segment with about 23.3 billion in revenue. Coming in the third place, we then have the global business segment with about 16.1 billion in revenue, which is then, last but not least, followed by the other segments with about 8.2 billion in revenue. But enough with the brief introduction. Let's get to the most interesting part for all of those who already are shareholders or want to become such, and that are obviously the distributions to shareholders. IBM currently returns capital to their shareholders through a dividend and to some extent stock buybacks. However, let's at first take a look at the dividend, which currently sits at about $6.56, equaling a current yield of 4.44%. Pair this with 22 years of dividend growth and a 5-year growth rate of about 6.68%, and you get what can be considered a really decent and growing dividend income. When it comes to the stock buybacks, these are a little bit harder to track and also actually fluctuate quite a bit. In the most recent year, these however sat at about 300 million. But let's take an actual look at the numbers so we can find out how sustainable these distributions actually are. First of all, we are able to spot a free cash flow that is somewhat stagnant throughout the years. However, it still must be said that it got a bump in 2020, which introduces some growth to the big picture. If we now put this into contrast with the total distributions, these look extremely sustainable in every year over our time frame, leading me to believe that there is actually a lot more distribution growth possible in the future. However, let's also take a look at the overall financial position of IBM, which we are going to do through the balance sheet. As per usual, let's start out with the year of 2016, in which IBM's total assets sat about 117.4 billion US dollars. These were made up by about 18.4 billion in equity, 42.1 billion in financial debt, and 56.9 billion in non-interest paying capital. But in order to be able to actually evaluate this even further later on, we want to calculate the net debt. This is done using IBM's debt and its cash position of about 7.8 billion, with which we get a net debt of about 34.3 billion. If we now compare this to the year of 2020, we can see an increase in total assets to about 155.9 billion. These were made up by about 20.7 billion in equity, 61.5 billion in financial debt, and 73.3 billion in non-interest paying capital. Let's however again calculate the net debt just like we did for the year of 2016, with this year's cash position of 13.2 billion. This time we get a net debt of about 48.3 billion, which is a somewhat decent increase. But let's also find out how sustainable the debt of IBM actually is and whether the debt has gotten more or less sustainable. This is done using the EBITDA, which after some basic calculations leaves us with a sustainability factor of 2.1 for the year of 2016 and 3.77 for the year of 2020. This indicates to us that the debt situation over at IBM has become quite a bit worse over the years. However, it has to be said that this includes the acquisition of Red Hat done by IBM in 2019, but more on that in just a second. Alright, so since we now have the financials covered, what we want to do is get the margin of safety, as this will help us with getting the fair price per share for IBM. And for this one, I have to be honest. Since a bunch of stuff out there on what may drive them is absolute nonsense, in my opinion at least, here is the brutal and honest truth. The leading and if not only upside to IBM is their cloud computing segment. I know it sounds harsh, but hear me out. As of today, IBM is one of the few mid-sized players in the cloud computing segment, bolstering a roughly 5% market share. While that on its own does not really sound like the huge upside that seals the deal, a 77% gross margin and recurring revenue due to cloud hosting being a subscription-based service does. And obviously, you also have to account for cross-selling, with IBM leveraging their various business services. This not only results in a business unit with recurring revenues, but also one with quite high profit margins, which could then be utilized in a similar way to what Amazon has done with AWS, which is funding new businesses. Therefore, I will be reducing my margin of safety by about 15%, simply due to the upside provided by getting into the cloud segment. However, I also have to admit that this is it with the upsides if you ask me personally. But let's get to the first segment of the brutally honest part, and that is that IBM is one of the companies that had its turnaround story told hundreds of times, but never lived up to the standards. This isn't necessarily due to mismanagement, but I personally think IBM has in the past been somewhat disconnected from reality and what the driving growth factors in their business segment are. Therefore, I personally am still somewhat skeptical on whether IBM is actually going to manage to break free from the historic trend of falling behind, for which reason I will also be adding 5% to my margin of safety as a measure of precaution. When it comes to IBM's downsides, I however have to admit that while their cloud segment may be one of the best things to happen to them, it also brings some dangers or more so risks to the table. 2 years ago, when I heard that IBM would buy out the company Red Hat for 34 billion, I thought to myself, damn, they are actually going all in on cloud. Up to this day, I'm however still missing the big growth that was to come from this acquisition. And to be honest, I don't think there will be a ton of growth coming their way in the future. Why is that? Well, the cloud segment is a highly profitable one that already has a ton of players such as Microsoft, Amazon, Google, and so on in the leading places. These are capitalizing highly on the ecosystems to draw in customers into their cloud segment and are being rewarded with high growth in the process. IBM, however, does not seem to be quite able to do the exact same thing, which will make it even harder for them to take market share in the future. And that doesn't even account for smaller players like, for example, VMware, that are out there to get the big players and take market share from them. Therefore, I personally have to say that for an all-in, I'm somewhat disappointed and afraid that their huge bet might even go south if the other big giants are able to tighten their grip on the market. Therefore, I will be adding 10% to my margin of safety. To now get the fair value of IBM, we have to take a look at the historic dividend yield. For the past 10 years, this sat at an average of 3.41%, thereby meaning you want to buy the stock if the yield is above that. To put it into numbers, with the current dividend of $6.56, the fair price to pay would be $192.37, which would mean with the current share price of $146.18, you would be getting a 24.02% discount. If we now want to calculate the value I would pay for the stock, all we have to do is again get the average dividend yield of 3.41% and add my safety margin of 25% to it. This gives us our target yield of 4.26%, which leaves us with a price to buy the company at of about $153.99. To sum it all up, I think if there was a time to buy IBM, it would probably be now. While the cloud segment isn't the best one if compared to other companies out there, it has to be said that you can purchase them at a far more reasonable multiple than most of their direct competitors. Yet it also has to be added that if the cloud segment does not live up to the standards of the current market and doesn't display some growth in the first real business year, obviously factoring out the pandemic, IBM will most likely run into some issues in regards to their share price along the way.